Common sense would say the best way to reduce the cost of a home is just to ask for a lower price when you purchase the home. Well, there are other tools and mechanisms that can be used to reduce the cost of that house over the lifetime of the loan. We're going to dig into that, and we're going to get started right now. All right, Gary, let's talk about seller credits. Specifically seller credits and any other tools that we want to talk about that will help a buyer reduce the cost over the lifetime of the loan. So
got it.
Let's start with the basics. What does it mean? What does it mean when you ask for seller credits to put towards closing costs?
It's just that. It's real simple. The seller is offering you on the closing disclosure a sum of money to be applied towards the cost. Now, this doesn't go against your down payment because remember back from videos past, we always got to bring the down payment. So these seller credits can be applied towards anything outside of the down payment, right? So buy the rate down, take care of some of your maybe your escrows. It can take care of your title work. It can take a pretty big chunk of money out, especially when you're looking at 2, 3, 4% of the loan amount as a cost, right? So that's what that looks like.
So really what you have is you have the scenario where we hear a lot of times, and we're talking to people either early on in the pre-approval process, and they're saying, well, I'm going to try and get $10,000 taken off the sales price. Well, what if you ask the seller for $10,000 in seller credit and use that money for the examples that Gary just said, but let's just assume you use that money to buy the rate down. So now in that example, if we look at a $400,000 loan, we assume that what's the monthly payment on a $400,000 loan?
Yes, monthly payment. So I got it pulled up right here. A $400,000 loan. We're just going to use 7 just because it's round numbers. 7%. You're at 2661.21. So 2,661.21 at 400,000.
Okay.
Now apply that same math to 10 grand, right?
Yep.
To the loan amount. That brings us to 390. So we're financing 390. Same 7%. That brings that payment down to 2,594.68. So 2,594.68 for roughly, call it $65.
$65 a month.
In savings.
In savings. So it would take you a long time to recoup that versus an example where you would say, take that $10,000 and use it to buy the rate down. Now you've purchased and you're doing a 30-year fixed, right? And you've used that $10,000 to buy the rate down. Now you're paying less in interest over the 30 years of that mortgage. So it isn't encapsulated just in a small window of reducing the sales price and therefore the loan amount. We're now talking about reducing the interest payment that you're going to have to make on the property for the life of the loan. So when we say it's better to go ask for seller credits than it is to ask for a price reduction, this is what we mean, right? And
100%. So much more flexibility.
And then how does this change the buyer's ability to qualify or improve their debt to income ratio? Yeah.
So in this case, the debt to income gets factored in when let's say that 7% rate we're talking about, you take that 10 grand and we can buy it down to 6.5. Now your payment is reduced by, a couple $100. Now your debt is lower. Overall debt ratio is lower because you've bought the rate down because of that extra money. Now it's not going you can get more in terms of lower payment by buying the rate than you can by you'd have to put a lot of money down to truly lower your payment. So
right. And so like it's interesting because you have this, at least in this market, whether it's very competitive and the price per square foot is analyzed by realtors really every week.
Oh yeah.
And so everybody's kind of hung up on the sale price and that might be tough to negotiate. But I think the point we're trying to make here is it's not the only lever you have to reduce the cost of the house. And I don't think, going in, especially with the market softening a bit, going in and asking for something like seller credits is going to be a big deal, right? It's not going to adjust. It's not going to adjust the sale price. So the sellers feel good about what they're getting. You're using that money effectively to, in essence, lower your payment, lower your rate. So it's interesting because there is this psychological perspective of buyer and seller, and they're at odds over the sale price. Yeah, it's important, but the buyer really is the one that's going to have to make the payments on the mortgage. So our job is to make it as easy and painless as possible. So we're going to look at all mechanism, and this is one that that we would use.
Yeah, that purchase price is it's the bang my chest. I got what I wanted as a seller.
Yep.
I offered lower as a buyer in one. However, I think it's more advantageous. I mean, there's deals that we're seeing come across our desk where folks are coming with nothing but their down payment to the closing table.
Yep.
Because they're getting all their closing costs taken care of. I think it's good. I should note too, there are limitations. You can't just go in and say, I want, $50,000 in seller credits.
Yeah, good point. There is a cap.
So conventional is a little convoluted, and I'll put this in the description below, kind of the breakdown of what it is. Basically 3% up to 10% down payment you can get on a conventional loan. Over 10%, you can get 6% seller credits, and then 9% over 25% down. So it's a pretty substantial, I guess. The other one we do a lot of FHA is 6% across the board. Doesn't matter how much you're putting down. And then VA is another one. It's about 4%. So, some big number. I mean, think about $300,000 loan. That's 18 grand on an FHA loan.
Yeah.
It's real money.
Money.
So cash is king. Right now, we're having these conversations across the board. I get asked a lot, especially if this isn't your long, dream home, you're not getting buried in this place. Man, the cash is much more important, in my opinion. Somebody else, feel free, drop the comments below. And I'm happy to, but I think just in this day and age, in this market, unless you're putting a strong down payment, meaning north of 20%, that cash is important, and paying, so that's just where I've had this conversation twice this week about it. And somebody came to the table the other day and he was like, hey, we're doing 20%, we're doing 20%. And then he got the disclosures and he's like, kind of like 10%. And I'm like, dude, you're buying a beautiful house that needs a pool and you've got 4 kids and you're trying to go to the next level with some other stuff, man, that's hard to recoup, $60,000.
Yeah.
Real fast.
Yeah.
So it doesn't hurt to go lower on the down payment. I know we're kind of going on a rabbit hole here, but the seller credits keeps that money in your pocket, right?
Yep.
Because, again, that could be anywhere from 3 to 5% of the total loan amount in terms of closing costs. So, it's 10, 15 grand on a $300,000 loan.
Yeah. And ask your loan officer to come up with this. It's not on you to figure it out. Ask your loan officer saying, hey, thanks for getting me pre-approved. I'm looking at this house. The loan amount is expected like this. I think I should go in at this price, but what if I go in and ask for seller credits? What are my maximums? What's that going to do for me over the life of the loan, assuming I'm holding onto the house for X amount of time? And then what point should this be brought up in the negotiation? Right from the initial offer?
Yeah. So, sorry, go ahead.
Yeah, no, I think that's it. Like, when do you want to bring this? It's not something you want to pull in at the card you want to play at the 11th hour.
No, you're really not able to do that because that is a huge negotiating point, right? Like, I talked to your point earlier about talking to the loan officer. My thing is this: when I get somebody pre-approved, and let's say we know we need seller credits. Let's say we need $5,000 in help to get the deal done. That conversation is immediately happening because it's not just the buyer, that we need the agent on board and comfortable with the negotiation. Because at the end of the day, it's not us negotiating; it's the realtor and the client.
Mm-hmm.
Yeah, and so they got to be good and understand kind of what we're trying to do. And our agents all, the majority of ours, they're good negotiators, and like when we, they know when we're like, hey, we need some help on this one, or hey, you know what, any little love you can get on this, it might be worth paying full freight,
Yeah.
on the asking price. Kind of go back to the original part of the conversation is like, hey, let's give them 400, but let's get 10 grand in cost and covered, and that's going to cover a lot. And
Yes.
you know, again, depending on the deal, you could be coming to the closing table with just your down payment.
Yeah. Yeah. So I think the 2 or 3 takeaways are: one, lowering the price isn't the only way to lower the cost of the house. 2, make sure you're working with your loan officer to understand what the math looks like. Like, hey, if we went in and asked for X, what is that going to do for the cost of the loan?
Yeah.
And number 3, you need to do this from the get-go, the initial offer. It's not a card you play halfway through. It can be a negotiating tactic, but we want everybody on the same page. We want buyer's agent, listing agent. We want everybody comfortable with that the offer that's coming in is the offer that we're going with. So
100%.
Anything else you think buyers need to do to better understand this? I mean, it feels like the biggest thing is talk to your loan officers, understand what the math is.
Yeah, I think when we have the conversation with the buyer and you kind of show them what that looks like, and they're like, $400,000 place, you're putting 5% down, let's say. So it's 20 grand. Well, you smack another 10, 12, 15 grand on top of there. Now that 20 grand turns into 30 or 35. That's a bigger pill to swallow. But then you say, whoa, hold on a second here. Let's talk to, your agent, and let's see if in the market you're in,
is there an appetite for it?
Is this a market where we can have these conversations? And if so, let's take some swings at it. No harm, no foul, right?
Yeah,
you get motivated sellers. It's time to move.
3 months ago, in this market where I am in Northern California, non-starter. Now, 3 months later, houses are sitting a little longer.
It's crazy.
Conversations totally in play. So hopefully this helps you. And as you're thinking about if you're out there looking to make an offer or going through the pre-approval process, please leave us a like, give us a subscribe, give us a thumbs up. And also, refute what we're saying in the comments. We'd love to have the dialogue. I think this is an important area that sometimes gets overlooked in the loan process. It's like, hey, they want a loan for X amount with X amount down. There it is. Their closing costs are on top of the down payment, and they're going to have to come up with cash. Well, we can get creative. So I think that if there's any 100%. Takeaway, it's like lean on your loan officer that you're speaking with to do the math and do their homework and make sure you're in the right place. Awesome.
I agree.
Well, Gary, thanks as always. Hopefully you guys enjoy this video, and we will be back soon with more content. Thanks, everybody. Have a great day.